Welcome to the Listen Money Matters podcast, where we always say, be greedy when others are fearful and fearful when others are greedy. For more information, visit listenmoneymatters.com. And now, here are your hosts, Matt and Andrew. Hey everybody, welcome to Listen Money Matters, the podcast. My name is Matt, and I'm here, as always, with Andrew. Andrew, how are you, sir?
Awesome, dude. Awesome. How you been, man?
Good. Good.
Good.
I just spent $550 on a friggin' plane trip to Orlando for one night.
I know, and you're not even going to Disneyland.
No. I'm just going for an overnight stay to do a presentation on social media, and then I'm gone. I fly in on Thursday, I sleep over in the hotel room, do my presentation on Friday afternoon, and then go right to the airport, and it was $550 because what I didn't know is that going to Orlando in March is expensive because everyone's going to Orlando in March. So that's what's going on.
You got to go peak season, right?
Yeah.
Pay for your hotel, not go to Disneyland.
Oh, absolutely.
It's like you're like a hipster, dude. Like your whole trip's ironic.
Yeah. I don't even get to see Harry Potter. I'm like, fuck Harry Potter.
Harry Potter's in Disneyland?
Harry Potter World is in Universal Studios.
Really?
Yeah.
I had no idea.
Yeah, my friend just got back from there. And him and his family went.
Was it magical?
I don't know. He said he got butterbeer. He said it was really good. I have to try it, I guess, when I go down there. Anyway,
I guess it's a Harry Potter thing.
I don't know. I've seen like the first three, and then I stopped. But
yeah, same basically.
All right. Well, okay. So today we're going to talk about something that you and I created together, but mostly you. And it's called the Average Investor's Commandments, and not to highlight any religious overtones, but it's just basically 10 rules that you follow.
Investors should live by.
Yeah, you follow these rules, right?
Yeah.
I think, do I follow these rules?
You follow some of them. You're still in the early stages of investing.
Oh, so we might as well mention it. I don't know if we mentioned this on another podcast or not because my brain's fried, but I started a Betterment account.
Woo! About time, dude.
I know.
I had to yell at you like weekly, daily.
I know. Oh, I put $2,000 in up front, and then I have $500 going in every month, and I'll probably adjust that as time goes on.
Badass, dude. That is how you do it. That's how you do it.
But I am obsessively checking it.
Okay. I mean, I understand. When I first started investing, I also did, and for me to tell everyone to not is kind of like. I mean, look, you eventually got to let it go. You know what I mean? Like, yeah.
I'll eventually get tired of me not seeing a huge increase in money.
You're like, today I made $20. Today I lost $10.
Yeah.
Today I lost $5 more. Then I made $30.
There was a day I made $25, and I was like, oh. And then the next day I was like, minus 14. I'm like, yeah, I should probably stop looking at this. But... So there's also with this Average Investor Commandments, it's part of a post that we just launched called the Introduction to Simple Investing, which is a brilliantly written post by Andrew. You did a very good job.
Thanks, man.
And it's very long, and it's actually one of the few posts that you've written that I've actually read like cover to cover, or blog post to blog post. It's super long. It's super good. It's inspiring. It's like. Cut the bullshit, stop trying to be a day trader. You're right. It's like...
Yeah. It's basically like it tells it to you straight.
It's cool to be average.
Yeah, because it's really profitable to be average.
It's hip to be square.
Exactly.
Okay. So...
I don't know why, but that made me think of Gumby.
Too hip to be square?
Because, I don't know, weren't his enemies like the square heads? Or the blockheads. Blockheads. There you go.
Yeah. Wow.
Damn, blockheads always ruining the party. Anyways.
And that's what Lucy called Charlie Brown.
A blockhead?
A blockhead. Huh. And his head was round. I never understood that. Anyway, so we're going to go through these commandments one by one. By the way,
I just want to totally side rail it again.
Yep.
And just say I searched Google images for blockheads because I just want to make sure I was right. Mm-hmm. And it's a travesty, but the first like million pictures are all Minecraft. I have to scroll like way down, and then I find the blockheads G and J. But anyways,
Yeah, one day you're gonna have to describe Minecraft to me. I don't play video games or any games whatsoever, and I
I have
keep
a
hearing
friend,
about it.
dude. I have a friend who's like in it, and like he like records video. He does like videos of how he makes his bases and shit. He has a Minecraft. He's like super into it.
Yeah, you already blew my mind. I don't.
Yeah, I mean, I understand it. It seems like it's very time consuming.
Yeah, so that's a whole nother topic for an episode, not on this podcast.
Minecraft, yes.
Right. All right, so we're gonna go through the commandments. I want to say what they are, and then I want you to elaborate.
Deal.
Okay.
So are we? Are we? By the way, are we going through the list first, and then, or you're gonna say it, and I'm just gonna?
I'm gonna say the commandment, and then you're gonna elaborate on the commandment, and give
Deal.
maybe we can come up with like, some examples on what this all means, or what these
Cool.
commandments mean, and how to put them into practice.
Absolutely. And I just want to say, like, these are like super important. Like, if you can get these commandments and like take them into the core of your being, like, you will do fine. Like, you will make money. You just
Yeah.
have to, yeah. Anyways, let's go.
All right. So the first one is think long term.
Yeah. So this is like the whole day trader thing. I mean, look, the guys in Wall Street, and I worked for two different banks. They have tons. I'm a data guy. There is ridiculous amounts of data, and there are like some of the smartest minds like analyzing this data and coming up with decisions. Like, you're not going to compete with these people. They have more information than you. They have more people working on it, and they're probably also smarter than you. So the trick is to not compete with them in these daily, weekly, or monthly fluctuations, but look long term. Because long term, the market always goes up. I mean, since the market has existed, and if you go to our post, you can kind of see we did a little graph. Productivity goes up, so the market goes up. It's just how it works. So if you think long term, you will win. If you try and buy and sell trends, get in on like market fluctuations, like your Wall Street will take your money.
You're gambling at that point.
Yes.
And this is not, and we're not talking about gambling with your money on Wall Street. You can do that at the casinos.
Exactly. Because it's probably more fun. Well, it's absolutely more fun at the casinos.
Yeah. Yeah.
Because at least the dealer talks to you and like.
There's wheel spins, and there's cards,
free
and
drinks.
there's free drinks. Yeah.
When you lose money or when you play Wall Street, and you try to win, there's just depression.
Depression and suicide.
That's right. Not funny, but we're laughing.
No, suicide's not funny. But so as like and is there any benefit to doing short-term investing? Is there any type of like investments that are short-term that are good?
Not that I think anyone listening to this podcast can make use of. Like, you literally have to be full-time at it and really, really, really understand. Like, I know a guy, like he's like, not, I wouldn't call him a friend. He's like acquaintance. He day trades oil. All he does all day is stare at oil graphs and buys and sells constantly all day. That's it. He'd one thing he could specialize in because it takes so much time and knowledge. I think it sounds pretty boring, and he's not super wealthy. He makes money, I think day trading is not for most people.
But with day trading, you have to have like a big lump sum of money to play with, right? Or else it's not even worth it.
Yeah, exactly. I mean, you could day trade and maybe you'll make a couple $100, but you'll work your ass off and you'll have ulcers from the stress.
Yeah. Yeah. Interesting. Okay. So that's a good first commandment. I think it's the best commandment.
Yeah. And then, by the way, we tried, I think, to order them in terms of like importance and or things that are important before the next thing. Like, you need to understand one item before
you move on to the next one.
Yeah.
Yeah. So the second one is invest what you can afford.
Yeah. So the thing is, like, you're investing long term. Excuse me. And you, yeah, you're investing long term, and you don't want to pull money out of your investments. The goal is to put it in there and let it work. Let it
Do its job.
marinate.
Yeah.
Yeah, make you money. So if you put your money into an investment and then rent comes due and you have to pull out, or you need to buy food, or you want to redo your kitchen, so you pull out money. This constant in and out of the investments is undermining your success.
And it costs money to pull money in and out.
Exactly. And with something like Betterment, it won't cost you money
That much.
but the point is that you need to give it time to work for you. And if you invest more than you can afford, you're setting yourself back.
Yeah, because I wouldn't. Yeah, because people are afraid. I had a friend email me and say, like, how, I'm afraid to put all my money into the stock market because what happens if I lose a lot of money and, I need that money for some reason? I said, well, then don't put that money in the stock market.
Exactly. And you know what? Like, I put the vast majority of my wealth in the market. But you know what? If you're not comfortable with it or whatever, put like 5% of your wealth in. Put like 1% of your wealth in.
Okay, so that brings me to a thing I had. I read a book called The Richest Man in Babylon. Have you ever read it?
No.
It's like an old school book about personal finance, but told through like fables,
Actually sounds really cool.
Yeah, it was good. It's like interesting to read because it's like, a sheep herder walks up to a guy who sells fish and you give him, whatever. So it's told like in basic trading, stories. And the common theme through the whole book is pay yourself first, right? So I think the book kind of alludes to it being around 10% of whatever you make. You should that should be your money first. Like instead of paying your bills and whatever, like that 10% is you pay yourself, and what you do with that money is you save it, right? And and when we say save, we're saying save it into an investment account so that money is then making you more money, and then every time you get paid and you're putting away that 10%, you're just adding more money to this pile that's churning and making you more money. So do you think 10% is a good number, or does it vary from person to person?
So I talk about this a little bit in the Mastering Mint book. Mm-hmm. It's like one of the last chapters. I feel really strongly about early retirement and the approach to it because it's very simple math. And at the end of the day, like 10% is great because 10% is better than 5%, which is better than 0%. But at the end of the day, it's really the amount that you save, like that percent reflects on how soon you'll be able to retire. Like that is the most important number is the percent that you save. And I have a chart and in the Mastering Mint book, and I don't have it pulled up now, but it'll tell you if you save 50% of everything you make, you could like literally retire in less than 20 years. Like I think like less than 15 years, but 10% is a great start. I don't want to belittle 10%.
Yeah.
But obviously you want to do it as much as possible.
So what about me? All right. So I made you watch a documentary on Netflix, and I don't even know if we talked about this yet on the podcast.
We didn't.
Okay.
And I loved it. It was called Inequality for All.
Yeah. Robert Wright. He was the head of the Department of Labor for Bill Clinton. And It's documentary, and it's about the wealth gap in America.
Mm-hmm.
And he was interviewing this couple, and they, one guy said he had $50 in his checking account. Another couple said she had like negative $40 or whatever the case is. And they said like they just did not have enough money after they paid all their expenses to save anything. So what do you say to somebody like that who I know, because there's a lot out there who say, this sounds great, like pay yourself first. I get it. It's 10%, not a big deal. But yeah, it kind of is a big deal. I mean, for me, back in the day, it was. You know, to me, I used to say to myself, like, I can't afford 10%. Like, I can't. No, I got to pay the bills. I gotta buy cap guns at Walmart. I don't have time for this.
Yeah. So look, I'm sitting here now, and I've learned and I've executed like a lot of these strategies, and so my situation is not back against the wall like some people.
Yeah.
But I have been there. I started with nothing. Nothing was given to me, and I think that regardless of your situation, except for maybe like the most extreme situations, there is fluff and there is waste. And if you are stuck and you're having real problems, the easy way is just to give an excuse and you don't make enough money and it's just not fair and blah, blah, blah. But most of the people it doesn't apply to, most of the people that doesn't apply to, you need to, if you're really tough, you're in a really tough spot and you really want to get out of that spot and you want more, you have to be militaristic about how you are with your expenses. Maybe you won't make any more money, fine. Because making more money is one half of the equation, the other half is expenses. And I think in the end, like, you're actually a great example of being militaristic with your expenses because you went through some ridiculously tough times and you slashed your expenses to shit.
Yeah.
Like, and you have had like a great comeback because in the end, like, you know what? If you're not making any money and you're really have a tough time and you can't afford whatever, like, dude, sorry, but you can't afford to pay $100 a month for TV.
Yeah.
Because you're in a tough spot. You should sit there and stare at a wall or do something. Sorry, I'm going to go on a huge rant.
No,
but like,
I know.
really,
Well, I gave back my BMW. I said, I can't afford this. It's just
you don't even live in the house that you own.
No.
You rent it out.
Right.
Like, yeah, I mean, like you understood the direness of your situation,
Yeah.
and you changed. You made. Most people don't. Like it's a lot of.
I will admit though, it's a big, huge blow to your ego when you have when you give that stuff up. I mean, it wasn't easy, but I just thought like, well, I mean, I don't have to go on this whole thing. Money is one thing, and you need it to survive in America, right? For the most part. But I just wanted to be happy. You know what I mean?
Yeah.
And the BMW didn't make me happy. The house itself didn't make me happy. Just being alive really is the only thing that's important. So, like the worst case scenario, is you die. Like that to me is the worst case scenario, or like you get like horribly injured or something, like something to your health. Your health is like the most important thing.
Yeah.
Without it, there's really no point to like living. So I don't know. Like to me, that just I was very materialistic, like super materialistic. Like I bought everything. I had to have like every new Apple product that came out, and now I don't know. I just stopped. Mostly through education, but I don't know. I know not everyone can do that, and people even tell me like, "Well, that's nice that you can do that. You're single, you don't have kids. You basically stripped yourself down to just one thing. It's not that easy. I have a family to raise, and I can't give advice to that because I don't have a family to raise. I have nobody who depends on me.
Right.
So I mean, again, not to go into that whole thing, but.
Yeah, I mean, I almost would want. I'm like totally. You pulled me in with this conversation. Now I want to like keep going, but like, look, we'll get back to Liz. I just want to say that like, I mean, I have a wife, so I have another person
and
that
cat.
also, and a cat, and damn, she actually doesn't eat a lot, but she poops a lot, and the litter is not cheap.
People don't know this. You do. I don't even know if you know this.
What?
I got rid of my dog.
You got rid of your dog?
Yeah, did you know that? Did you know I had a dog?
I think you told me you gave it to your parents or something. Yeah.
And I don't even think it was because I couldn't afford it. I mean, it definitely wasn't because I couldn't afford them. I mean, I could definitely afford them.
You couldn't spare the time to walk.
That too. I was so busy with work. But my parents, one of their dogs passed away, and they have another dog. And that dog wanted company and he liked being over there, and there's a yard he can play in where here there's no yard. My parents were like, you know what, he should.
That's pretty big of you to be able to do that.
Well,
I mean, you still get to see him, so
yeah, I still go over there. I mean, I just saw him today, so yeah, no big deal. But I mean, it's one less expense. I cut that expense. I mean, I had to buy dog food. I had to get him groomed, because he was a shaggy dog.
yeah. If you can't provide for yourself, how could you provide for other people?
I know. I can never have kids. Oh my god. Anyway, let's go to number 3. Number 3 is buy what you believe in.
So
I have a tough time with this one.
look, I think a lot of people have a tough time with this one.
I don't know if I believe in anything, like business-wise.
Dude, you definitely believe in things.
Like what? Give me an example. And what do you mean? But what does this mean?
It means like, look, here I am. I'm a technology guy, and I love Apple, and I invested in them back when no one would invest in them because they were nothing. I invested in Tesla. I mean, those are two successes of mine. But I have a buddy who I've been talking to on Facebook through, the site. He found it, whatever. And he's a music guy. And he knows lots about music and he's passionate about certain things. So we're working together to get him invested in things that he knows and understands and believes in. Because, like, look, and I don't know much about music, but, there's how many guitars and, if you've tried them all, whatever, but you could say, like, Les Paul is the best and they have this new thing and it's timeless and whatever.
The company's Gibson, by the way.
Yes,
Gibson
that shows how little I know about it. But I guess the point is that I could sit here and I could tell you about some technology company like Optimizely that's awesome and blah blah blah. But you don't know about that, so you would be a fool to invest in what I say because I could be wrong, and the thing that protects you from following my mistakes blindly is your own brain and your own knowledge.
Well,
like don't.
Oh, I'm sorry to cut you off, but I actually have a story which I've told before, which is the first time I ever invested was a guy at work. He was an investor. He played the stock market. He read the Wall Street Journal every day, and he's like, Howard Stern's moving over to Sirius Satellite Radio. How could it not be a great buy? He's like, I'm definitely going to buy some stock. And I was like, that makes total sense to me. I, first of all, never listened to Howard Stern. I watched private parts. It was about as much as I knew about Howard Stern. So I go, yeah, that makes sense. So I went and bought Sirius Satellite Radio. Turns out the guy who gave me the information never bought any stock in Sirius Satellite Radio, so he wins. But I lost a ton of money. And the first thing I did was I invested, and I'm going to say I invested like $1,000. It wasn't a lot of money, really at the time. Because I was working. But, I mean, it's a lot of money when you're, younger. But anyway,
Right.
I went and bought satellite radio. I went and bought Sirius because I'm like, hey, if I'm investing in this, I better know what this is all about. So I had already invested into it, bought satellite radio for my car, and fucking hated it. I hated satellite radio. And it turns out it didn't work out. I also bought stock in Pandora. Because I'm like, that makes sense. Then I started listening to Pandora, and I don't like Pandora, which people are gonna think I'm crazy, but I don't. I don't like the commercials. It picks songs that I don't want to listen to. I'd rather just listen to my own iTunes library.
Dude,
I should invest
and that's
in
the
iTunes.
thing. You know what? Like, maybe I know you're a music guy, but maybe if you use like Spotify, and I hear they're going
Tried that
very
I
soon.
tried it, didn't like it either.
No,
Nope.
But I mean, I think that the thing is like if you don't like it personally, like how could you invest in it? It's like, dude, you go and you bust your ass and you make this money, and then you're gonna throw your money after something that you don't even believe in. Like, I think that's crazy.
Which leads to the next commandment: do your own research. Commandment number 4.
Yeah. Because look, you know what? Some dude told you about Howard Stern moving over to Sirius. Like, I don't know. Do you think people who listen to Howard Stern are going to buy satellite radio because they love him? Or do they listen to him because it's free and it's just on the radio?
I didn't know. Yeah.
I mean,
Didn't do any research, quite frankly.
Yeah, I mean, like, is Sirius profitable? At the time, they were not.
No, they weren't.
No. Like all these things. It doesn't have to be. And I think I pose like a few questions in like the actual post.
Well, you say underneath it, you say maybe you love bananas, but if you don't understand the banana business, you either figure out how it works or don't invest in it. Which seems, and you ask, is the banana business profitable? Are they innovators? Or are they just people milking an existing product? I don't know. I don't even like bananas. So I would invest in bananas. It's a perfect example.
I mean, it was an Arrested Development. It was a shout out to banana stand, banana business.
Shit. You threw an AD homage in there. I didn't even know.
Right.
It. Perfect. I love it.
One of the first posts on the blog has a picture of a banana stand, and it's talking about. It's a common theme.
Yeah, I always throw. Every time I write something, I always try to throw something from Arrested Development in it. I watch it every night. It's the greatest show on television.
We have to watch the new season. We only did a piece of the latest episode.
I'm on first. I continually watch the show every single night for the last 5 years. So every night before I go to bed, I watch like 1 or 2 episodes in order. So I've seen the entire 4 seasons probably, I don't know, 100 times over. Not even like exaggerating.
Like when you get drunk, you just like become Tobias.
Yeah, exactly. So yeah, but back to that. I mean, do your own research. It's something I never did, and now I know.
I mean, if you're putting your money into something,
well, okay,
you should at least be personally confident that it's a good idea, not just like Jim Cramer said so, and
How do you do your own research? Where do you even begin? Like, what do you do?
Google for the company and just read about it. Like, for example, I invested in Tesla.
Yeah.
And if you search Google, at the time I invested, it was like, oh my God, there are fires. The cars are like terrible, whatever. And it wasn't like I did the math. Elon Musk posted something on the Tesla blog, and he was like, guys, statistically, gas-powered cars are actually 4 times more likely to light on fire than Tesla cars. The thing is, gas cars lighting on fire is not news. It happens all the time.
Yeah.
But my cars that are new and fancy and whatever, they lit on fire like 2 times. Everyone's flipping out. And so when you think about it logically, and I read his post, and everyone in the world read his post, or whoever was interested, but the stock price didn't move. It was still low. And I was like, this guy is speaking logically. And I already liked the company, the CEO, so I put my money in. And it could be just like that and a gut, or you could go into details of like how much profit they make, whatever, blah, blah, blah. But it's up to you. And I think that you should go as far as you feel like you should go.
And in the news today, Tesla is being banned by Chris Christie to be sold in New Jersey.
Yeah, dude.
I didn't read about it. I just saw a headline, so I don't know anything about it. And we're in New Jersey, and I don't like Chris Christie, and
no, he's just
I like Tesla.
Dude, I love Tesla. Elon Musk he found PayPal and SpaceX, the first public private company, whatever, to dock with the International Space Station besides NASA. Like, the guy's brilliant. Like, he knows how to lead engineers. I'm super bullish on his stuff, but
cool.
Chris Christie, the only thing I'm bullish on with him is like Twinkie consumption or something.
Yeah, he's very overweight. That's like the only thing you could say about him. Besides that, and Bridgegate, I guess.
Yeah.
So, number 5 is, I like this one because it kind of, it's set it and forget it. Which is vague, but it's sort of like what I'm doing with Betterment. Like, I need to just put money into it and like not think about it. Just let it do its thing.
I sent this list over to my dad before like we published it, because I like to, when I have like interesting things, I want to see what he thinks, whatever. And he liked all of them, but he did not understand what I meant by set it and forget it.
All right, so explain it.
So yeah, but I felt like we're just gonna keep it anyways.
Mm-hmm.
I mean, like, it
rhymes.
But I said it. The thing is, like, we have such limited time now. We want to spend times with our friends, and we got to work and we need to sleep, and we just want to do all things, and everything's pulling at our time. Investing should not be one of the things, especially since we're not trying to day trade and we're looking long term. So I feel that a key approach should be automation, and automatically investing every month, and letting your investments, say in a betterment style, automatically rebalance. So you don't have to worry about it, because you shouldn't, and you don't have time to.
So in a 401k where the money's just kind of automatically taken out of your check before taxes,
Another perfect example. Yeah. Every
or
time you get paid, it goes right into the 401k, a certain percent, distributed into the funds, exactly like you said it, that one time and never again. And that's really important. That's a great way to save, because it happens like when you're not looking.
yeah, it's all behind the scenes and you don't even know. And
Yeah.
I think that's the best, because I mean that's the way to trick yourself into saving that 10%, because even with Betterment, like I have Betterment set up to automatically withdraw $500 in the first of every month. And I mean, I'll know when it happens, but it's even better like when I actually had a job and I was getting paid, every 15th and 30th of the month, I would have Ally Bank just automatically withdraw $50 from my account on that day. And I had it set up so where like the money would be direct deposited and that $50 would be taken out. So by the time I looked at my account, it was already negative $50. You know what I mean? So I never really saw it. It just kind of, it was almost like if I was getting paid, $2,000 every 2 weeks, I would only see, $1,950.
And look, that's how it should be.
Yeah.
Why should you be bothering yourself with this? You think about it once, you set it up once,
Yep.
and then you just reap the rewards in the future.
And you can do that with any investment account nowadays. Right?
Most of them will accept that, like automatic deposits, whatever. Like I'm a personal fan of Betterment, but Fidelity also supports it. So
Yeah. And I know Share Builder does. And I know 401ks, obviously. Which then leads us to commandment number 6, constantly contribute.
yeah. So I mean, one thing, it's really important just to be investing constantly. But one of the things is like the market goes up, the market goes down. Then there's these concerns that when you buy, like, is it the right time? Is it too expensive? Is it if you invest on a consistent basis over a long period of time, the technical term, and it's in the article and infographic, it's called dollar cost averaging. And basically what happens is you wind up mirroring the market. So when the market's up and you buy it, great. And when the market's low and you buy it, great. And when it's in the middle, and as it goes on, month to month or week to week, however frequently you do it, you basically mirror the performance of the market. And since we know the market performs 7% conservatively on average, that's what you can expect. So it's not like you're timing it and you bought it at the peak in 2008 and then it goes down and you have to wait 10 years for it to fix itself. No, you've been buying all the way up, you've been buying all the way down, and then all the way back up again. And so it's irrelevant. Remove the timing from the equation. Like I said, we're not day traders. This is not our full-time job. Just let it, work itself out.
So the next one, and I like that, because it seems simple. And I was going to ask you about dividends. I was thinking about asking you about dividends because
Please.
Well, so Betterment, since I just started and I'm kind of learning it, it's not really hard to learn. It's pretty easy. But it like I got an email that said we paid you dividends. Mm-hmm. So is that money just gets paid to me and it's like mine, and it's like it gets reused?
Yeah, so Betterment will reinvest it for you automatically. If you did it on your own, you would have to decide if you wanted to be reinvested or not. And basically, a lot of these big, super profitable companies like GE or Johnson and Johnson or whatever, a percentage of their profits get distributed to shareholders. So you get a check.
Interesting. Okay, I didn't
So
know.
you get the
It's like
gains.
interest.
Yeah, I mean, you get the gains of the stock, and they cut you a check. So it's like you're making money the whole time you own the stock, and if it's growing, great. You know.
Yeah. Cool. All right. I just wanted to know that. We're going to combine the next two because they're similar. So
Sure.
number 7 and number 8, which are one full quote by Warren Buffett, but we wanted to split them into two because they're they're opposite of each other.
Right.
And the first one is be fearful when others are greedy, and be greedy when others are fearful. And you always say this.
Yeah, I'm kind of obsessed with it because some of the best investment decisions I made was look, I did make some bad investments at the peak of the market, but I've always had money set aside because I'm cautious and I don't want to be screwed. So when the market crashed, there were these killer deals, like deals that were not, I didn't think could even exist before the crash. And you get in cheap and I mean, you're at the bottom. Like
Yeah.
it really can't go lower. It didn't, so the thing is when everyone is making money and your neighbor's cousin who is an idiot and can't and he's like I don't know, he
Whatever.
cleans bathrooms at McDonald's, if he's making money in the stock market, you should be very concerned because it shouldn't be easy to make money in the stock market. Like you should have to buy and then wait long term. But if he's making tons of money month to month, I would pull out.
Like Wolf of Wall Street.
Yeah,
That guy was making bank quick because he was selling.
because he was cheating.
Yeah, he was cheating. He was being
So-
greedy.
Yeah, exactly. So you always want to be thoughtful, logical, and not emotional when you do this stuff. So I think if you keep that in mind, you'll be all right.
So I probably should have kept Sirius Satellite Radio, huh?
Hey, I mean, you only lose the money when you sell it, right?
Yeah.
If you held on to it forever, I'm sure. I mean, they got bought by XM, blah blah blah.
Right.
I'm sure.
Well, they merged,
It's-
so yeah.
Yeah, and then that goes back to one of the previous ones, like long term, dude.
Yeah, long term for sure. Here's one I don't really understand. So this one, you're gonna have to explain a little bit to me, which is number 9. Find and remove frivolous fees. What fees are you talking about?
So, you have say you have a 401k, and many people do, and I encourage people to have 401ks. The reason the banks fight each other to be the 401k provider for a specific company. And the reason is because with a 401k, you get to choose from like 15 different investments. Like not the entire stock market, just 15 ones. And that company that manages your 401k chooses those 15. Some of them are their own funds, some of them are not. And what happens is almost all of these funds have really high fees, and the company managing your 401k also charges a fee. So what happens is if you blindly invest in your 401k, I almost guarantee, I actually guarantee you're paying more than 1% in fees. Because maybe the fund is 0.8%, and that's actually really low. It's probably more than 1%. And the management company will charge at least 0.5%. And in the post, we show a graph where if you only had 1% fees total over the course of 30 years, a fourth of the money that you could have made goes to the bank.
So a quarter, you mean?
Like 1/4. Yeah, 25%. I mean,
Okay.
and that's a lot because you think about it. So you could have $100,000, but instead you have $75,000. And the only reason you have $75,000 is because you didn't take the extra 5 minutes and look at the fees.
And
Because
why would a bank charge fees? What are they actually doing?
what are they doing? They're
Like, what are they?
managing the funds, managing your money. I mean, it's mostly automated, but why are they charging fees? Why do they charge you fees anyways? Because they can and because they get away with it and because
So,
most people don't pay attention.
how do you avoid it then? If there's only 15 funds to choose from,
So some of them do have lower fees. You should
Oh.
focus on those. And with funds, they have to disclose the fees. So with something like a 401k, sure, you may be locked into some things, but you could still minimize as much as possible. But on your own, if you're investing, is say you pick a fund, right? Like Vanguard, for example, they have like 0.15%, like not like almost nothing fees. Whereas like Fidelity, and I actually love Fidelity, they may have like 1 point something percent fees. So for similar funds, I would almost always go with Vanguard because it's more money in your pocket over the long term.
are there any fees? I'm sorry. Are there any funds that have zero fees?
No.
Okay.
No, I mean, I Vanguard, as far as I know, is by far the lowest, and
So it really should say find and reduce frivolous fees because you can't completely remove them
so
unless
yeah,
you're talking
not
about
always.
something else too. Unless there's other places where fees are involved where you can remove them. Like
Yeah, I guess there's always going to be fees, and I think the thing is like think about and I think we've talked about this before, but think about investing yourself versus investing in betterment. And not to say that betterment is the be all end all and you must use it, but if you're investing on a consistent basis, like monthly, and you're trying to diversify, so you purchase multiple things each month, you could pay $6 per transaction with something like Share Builders. So you may have 4 transactions per month. So 6, 12, $24 a month you're paying just to do this. Or Betterment, you get the benefit of economies of scale because many people are doing this and they're investing in all behind the scenes for you. So they pass you a much smaller fee, 0.35% of your holdings. And so if you were trying to do what Betterment did, you could never compete because it would be more expensive for you. So a way to reduce it, I guess, is to, instead of go into index funds yourself, go through someone like Betterment.
right, because there's like a bulk buyer basically.
Yeah.
It's like shopping at Sam's Club over Target, I guess. They just
Yeah,
have bigger buying power.
They pass the savings on to you.
Yeah. Okay. Got it. Makes sense. And finally, the last one, diversify. Diversify your bonds.
Yeah, that's really
Or
important.
actually, I think it's diversify your portfolio.
Your bond portfolio. I don't know.
Well, so you say if it can fail, it will fail. So
Yeah.
explain why. All right, and because there's to me there's two different types of diversification. It's a tree, right? Because diversification could be the very outer layer of just your existence. So there's you, and I guess another way to put it is don't put all your eggs in one basket. So
Yeah.
as a human, I would have a 401k if I had a job. I would have maybe a brokerage account where I would just trade in stocks here and there. Like if I wanted to buy Apple or Tesla, whatever, or Sirius
Right.
or, rent.com. Or I could have my house, which is an investment. And I could have a Betterment account.
Right.
And I could have a Roth IRA for retirement,
Right.
and then within each of those accounts, besides the home, because the home is one thing, each of those accounts you can have multiple take example, the brokerage account. If I started an account with ShareBuilder just because I wanted to trade stocks, just because I wanted to buy Tesla, just because. I
Yeah.
could buy Tesla, I could buy Apple, I could buy Google, I could buy, RCA. I don't even know if that's a company anymore. I could buy like all these different companies, and that is like diversification within diversification.
Yeah. So, having different accounts. Look, if you have if you have your brokerage, your 401k, and your IRA, and you invest in the same investment across all three, like
That's not diversification.
yeah. The thing is, because 401ks are limited in what you can invest in, chances are it's not what you're investing in your brokerage, and Betterment's investing in index funds. And the thing is, like, I'm hailing from the technology side where no matter what we do, things always break. The hard drive fails, the server dies, there's an error in the code or something. I see it in life. Like there's always issues. And so you could have all of your money in this one house, and then the 1 in 1,000 year tornado comes by and your wealth leaves with the tornado. Or you could be a little smarter about it, put your eggs in multiple baskets. So if one egg breaks, one basket gets smashed, whatever, you don't lose everything.
Not to be a nerd or anything, but when you put it in terms of servers, it like makes way more sense to me. Because I just look at like companies like, oh man, like if you had a website where you were selling stuff, right? You had an e-commerce website, and you had to host it duplicate on 4 different servers. And then what do they call that? What do they call the box that before it enters in the server? Hold on.
Load balancer?
Load balancer, that's it. So basically what it does is it kind of like serves up from all different boxes.
And it divvies a load, yeah.
Yeah, and then but if one of those servers goes down, it
automatically reroutes the traffic.
Yeah, it reroutes the traffic, and your website's still available.
Yeah.
And the more servers there are, like you have the less chance of, if and oh, you know what it also reminds me of, and I don't even know why I know this. Planes. Planes have like 4 engines and also other like fail safes on top of that. So like if one of the engines blows on a plane, the plane still flies. If 2 of the engines blow on a plane, it still flies. If
engine problems happen. Imagine if planes would be falling out of the sky all the time. They had like one engine, then they put all of their faith in just this one engine working.
But that's what happens sometimes. And then but then they have a backup engine that like never gets used or something. I like my friend was telling me there's a bunch of fail safes because he used to work on military aircraft. So he said he's like, dude, it's like kind of impossible for it to happen. Like it's just there's so many different,
And there's got to be, because like these are people's lives on the line, or livelihoods on the line.
Yeah. Yeah, so I guess...
Or websites.
Websites, yeah. So just that idea of not putting all your eggs in one basket like I did with Sirius and hoping that Howard Stern, takes it to the next level, and he doesn't, and I'm out, $1,000. I could have bought maybe like $100 in Sirius, maybe $200 in something else, and $400 here. And if Sirius went down, like
fine, you lose your $200, but you didn't lose everything.
Right, I didn't lose everything, right. Although with a house, it's like how many, you can't own like multiple houses. I mean, I guess you could, but good for you. Good for you if you have multiple houses. Like, my house in Oklahoma got hit by a tornado. Don't worry, I got like 50 more houses across the United States.
Okay, Mitt Romney.
Yeah. Okay, Mitt. So that's all 10 commandments, and to reiterate and go back through them, number 1, think long term. Number 2, invest in what you can afford. Number 3, buy what you believe in or buy what you know and feel comfortable in buying. Number 4, do your own research. Number 5, set it and forget it. Andrew's dad doesn't know what that means, but hopefully the rest of you guys do. And now maybe if your dad listens, now he may know what it means now.
Hopefully clarified, yeah.
Hopefully clarified. Number 6, constantly contribute. Number 7, be fearful when others are greedy. And number 8, be greedy when others are fearful. Number 9 is find and remove frivolous fees or find and reduce frivolous fees. So go after the funds out there that have the lowest fees. And that reverts back to do your research.
Right.
And then finally, diversify your portfolio. Do it. Spread your wings as far as they will go, and don't put all your eggs in one basket.
Exactly.
So that's it for the average investor's commandments. I hope you like them, because Andrew worked really hard on coming up with them, and then I worked really hard on putting them in order, and then I worked really hard on making a graphic, and then I worked really hard on stealing the entire idea and making it my own.
That's right.
Yep, that's how it happened. And also check out our most recent post. I mean, it won't be recent probably when this comes out, but it's listenmoneymatters.com/introduction-simple-investing. And if you just go to the invest section of our website, it's the first post that comes up, and it's super good. You should totally read it.
There's much more than just the commandments. We go into detail on like all the basics.
Yeah. And
if
it's
you
really
want
basics,
to invest, sorry?
I'm saying, like, you really, like, it almost basically what you did is like try to like squash the fear in people, because I have that fear, I still do. And my mom has, like, she saves a bunch of money, but none of it's in the stock market. She just has it in a savings account.
And look, yes, you will make money, and I really want people to read this, and you'll make money in a savings account, but over 30 years, you could, on $1,000, you could expect to make $281 in a savings account, but an investment account, you could expect to make $6,000.
Wow.
So it's like dramatic. But
yeah.
Anyways, we set the basis for investing, because the next one, we're going to get into the thick of it.
Yeah.
And we're going to start making some money.
And you know what? This is still under an hour, this conversation. And we have about 10 more minutes left until it is an hour.
I have a few more sips of my drink, so.
Do you want to just sip drinks for the rest of the 10 minutes?
Sure, let me see.
Yeah. That is compelling podcasting right there. So is there anything, like, I guess we might as well just stretch this bad boy out. Let's make it an hour. Let's make it an hour. So do you have anything else out of this article that you wrote that you think is important to discuss? Or do you want to go back to discussing... No, let's not do that.
Yeah, so I'm going to go out on a limb and say that everything in this article is important to discuss. But we'll do like a brief run through. Because you know what? Maybe you can't read, or you don't like to read,
yeah,
or whatever. The gist of it is, I'm like, hey guys, like, you should be investing. And I basically break down, like, what does investing mean and why should you care? And I basically tell you that savings account, checking accounts are not investments. And when you put your money in like a checking account and you get 0.5% interest per year, what is really happening is the bank is taking your money, they're investing it, they're making 7% or more, and then they just give you 0.5%. So imagine that if, like, your sole job was to accept other people's money, make a ton of money on the back end, and then just pay them a little sliver of it. You don't even have to come up with the money. They give it to you. So that's like the gist of banks. So the beginning piece of the article is basically like, take back the power, take back your money, and make the profit yourself.
And you still need banks. You still need a checking account.
Yeah, I mean, you still need banks, but you don't have to let them profit off your back. Why don't you profit and let them take their minuscule sliver?
Let me ask, if you knew somebody that had, say, $25,000 in a savings account,
I would vomit, dude.
But how could you convince them, or what would you say to convince them, or even how would you tell them how much to? Because it's obviously in a savings account because either they don't know or they're afraid, and I guess they're interchangeable. So, like, what would you say to that person, and how would you get them to, like? Would you tell them, hey, instead of taking all $25,000 out of your savings account and putting it into a brokerage account and buying stocks and stuff, would you say, hey, take $500 every month out of your savings and transfer it to a thing and keep it consistent? Would you tell them that?
Yeah, absolutely. Because the thing is, one, I'd ask them like, what's the likelihood that you're gonna need to withdraw this $20,000 next month for something important, urgent, or purchase? And I'd be like, what about 2 months, 5 months, whatever? And then I'd be like, well, if it's just gonna sit there, you're not gonna use it.
Yeah.
Why don't you put it to work? You go to work every day. You wake up, you gruel through that stupid shit, make your money do the same thing. And you know what? If you have $20,000 and you put 5 to work, and you leave 15 in there, it probably won't make that big of a difference. You'll still have a lot of money available, yet you at least have some money earning for you. You should at least have some. Like, to have none is just
ludicrous.
It's silly. Yeah, it's ludicrous. It's like a rapper.
Well, let me ask this question. What about that argument that I used to make, and I still would argue that I kind of make, which is I'm living right now. I'm alive right now, okay? And somebody paid me $2,000.
Right.
Why wouldn't I want to, like, spend that money, and why would I want to take some of that money and say, put it aside so that when I'm 60 years old, I have a lot of money when I'm 60?
So, okay,
that,
it is not only for when you're 60, but then I'd ask, why did you take the time to learn a skill? Why are you working on building these websites that will help people? For people in the audience, why did you go to college if you did? Or why did you do,
to make money?
But you could die tomorrow. And you know what? The time you spent in college, you could have just been at a bar. And, but instead you're in a classroom. And the thing is like when you apply that short-term logic to your whole life, it sounds silly and it doesn't make any sense. Like, so if you're going to be long-term with other things in your life, why don't you just go all in? Why don't you just be long-term with everything? You know what? You could die tomorrow and the money's going to go away. But you know what? If it was in your checking account or in an investment account, what difference does it make? Like, you're still not going to be alive to use it. But in the hopeful chance that you are alive because you're going to try and be healthy and whatever, then you could buy that castle in Brooklyn or whatever you want.
So, but what about, I don't know. It's a hard argument to make because I'm thinking I could take that $2,000 right now and go blow it on, like, beer, I guess. And that would be a great weekend. Spending like $2,000 on beer in, like, I don't know, Colorado or something. Like, beer and weed and hookers. Just like for an entire weekend. Just like just go completely like ballistic.
Dude,
that would be super fun.
So dude, you're drunk,
Yeah.
you're high, and you're with the hooker.
Yeah, so I have an STD.
She convinces you to get into the sex swing.
Yeah.
And somehow you break your leg.
Okay.
And now you need to go to the doctor, but you spend all of your money on hookers and sex swings and pot.
Well, all right.
So
Well,
now you got this gimp leg.
That's far-fetched. I mean, I'm not going to be in a set. It's not going to go in a sex swing. I'm not going to do that. So, new argument. I'm just saying, instead, like, look, I agree. Pay 10%. Like, pay yourself first. I agree with that, right? But what about the people who say, like, well, fuck myself? Like, I'm not going to pay myself. I am paying myself first by going out and buying an iPad.
Okay, I'll tell you what. So you're very unique in that you have your own business and you're making money, and so you don't really answer to anyone. But I would say the majority of the people do have to answer to people. And I'll take an example. I'll give you an example. So I was talking on Facebook with this listener, reader. He loves, what we do, and he's fighting the war in the Middle East. He's in the military. Now, he's doing it now, and he's young, and he's able-bodied, and, but he's planning for his future. And the question is he planning for his future so that he can, go and chill with his family and whatever? Or does he want to be fighting until he's 100 or until, as far as you possibly can? And I guess the thing is, like, do you want to work when you're 90? Do you want to work when you're 50 or 40?
So it's about the future, I guess, is the bottom line.
Yeah, I mean, it's really like, look, if you hate waking up for work now, you're gonna also hate doing it tomorrow, and on next week. So, why don't you put the pieces in place to stop the madness?
Right. Okay, and maybe to do it sooner. The more
Yeah,
you, the
I
more
mean,
you invest.
it is about the future, but you'd be crazy to say the future doesn't exist.
Okay. I like the way you wrap that up. So we just hit the 60-minute mark. And
Good,
we're
because
gonna,
I have to pee.
all right,
really
good.
badly.
Good.
Yeah.
I don't, but we're going to close this thing out. Thank you, everybody, for listening. As always, please leave us a positive review on iTunes. That helps us out greatly. Download our episodes. Go back and listen to some old episodes. They're fun. They're just like this one, except shorter. And check out, listenmoneymatters.com, and, come and talk to us on Facebook. Come talk to us on Twitter. And, we want to talk to you guys. We want to have fun, and we want questions, and anything we can do to help, we will try. We will do our best.
Yeah, and ask us questions. Talk to us. We will be answering your questions until it's like we're physically unable to answer your questions because there's too many.
Until our fingers are
Bleeding.
riddled with arthritis and we can no longer type.
Exactly.
But by that time, we'll have so much money invested that we can just take off and go to Cabo for the rest of our lives, right?
There you go.
Perfect. All right, Andrew, take care, my friend.
Later, dude.
Later.
Thanks for listening. If you enjoyed the show, please leave us an honest review on iTunes. And for more information, visit listenmoneymatters.com. Peach out, home slice.